Today, we're going to pull back the curtain on a question that's right at the heart of finance. When you make a trade, who exactly is on the other side? I mean, really think about it. Every single time you click buy on a stock, somebody, somewhere is clicking sell. If you're betting a currency is going to shoot up, someone else is betting it's about to fall. See, the market isn't this big, abstract machine. It's just a huge network of people and institutions, and they all have different goals, different timelines, and totally different strategies. So, who are they?
Well, to answer that, we've got to meet the players first. So let's break down the whole cast of characters in this financial ecosystem so you can see exactly who you're sharing the field with. Okay, let's start with a super simple definition just so we're all on the same page. A market participant is literally anyone who's in the game. It could be a student buying their very first share of a company, or it could be a massive pension fund that's managing billions of dollars. If you are buying or selling, congratulations, you're a market participant.
You know, at a high level, you can slice and dice these participants in a bunch of different ways. You've got retail traders, that's probably you and me, up against these giant institutions. You've got speculators versus long-term investors. And of course, the pros versus the novices. But to really understand what makes them tick, we need to dig a little deeper. So one of the most powerful ways to get a handle on the market is to sort everybody by their time horizon. In other words, how long are they planning to stay in their position? Because that one single factor, well, it changes absolutely everything about their approach. Take a look at this spectrum here. It's all defined by time. Way over on the far left, you've got scalpers. These guys are in and out of trades in mere seconds. As we move to the right, the time frame gets longer. You've got day traders, then swing traders, all the way to the other end with investors who might be happy to hold something for years. And this contrast is it's everything. A scalper's entire world is the next few seconds. They're trying to grab tiny little profits over and over again. An investor, totally different story. They're looking at the big picture, focusing on the fundamental value of an asset over months or even years. They could be on opposite sides of the exact same trade for completely valid but completely different reasons. All right, so beyond just the duration of a trade, it's the methodology that really defines a participant. It's not just about how long, it's about how. What's the logic they're using to make their calls? And here we see another whole layer of how to classify people, their strategy. For instance, you have trend traders. They're the ones trying to catch a market wave and just ride it. And then you've got reversal traders doing the exact opposite. They're placing their bets on the precise moment that trend is going to fizzle out. Each one of these strategies is a totally different lens for looking at the very same market. So here's the crucial point, right? When enough people using a similar strategy all act at the same time, like a huge wave of trend followers all buying the second a price breaks a key level, their combined actions can actually create the price move they were hoping for. It's kind of like a self-fulfilling prophecy. And this is exactly why understanding all these different strategies is so important. Okay, so we've met the players and we've had a peek at their playbooks. Now let's talk about the fields they play on and the equipment they're using. We're talking about markets and instruments. Let's take a classic example, like gold. If you want to trade gold, you're not just limited to, buying a physical gold bar. The financial world has created all sorts of different tools to give you access. So sure, you can buy the actual physical asset, that's the main market, but you can also use things called derivatives, which are basically just instruments whose value is derived from the price of gold. For example, a futures contract is an agreement to buy it at a set price on a future date. An ETF is kind of like a stock that just tracks the price of gold. And a CFD lets you speculate on the price movements. All of these give you exposure to gold without you ever having to actually touch the metal. So think about it like this. You've got the main markets over on the right, the actual assets like stocks or real estate. And on the left, you've got all the derivatives, the financial tools like options and futures that let you trade on those markets. It's kind of like the difference between owning a sports team and just betting on the outcome of the game. So we've broken down the who, the how, and the what. Let's pull it all together. Why is understanding this entire ecosystem so critical for anyone who's getting involved in the markets? Here's the bottom line. The market isn't one single thing. It's a living, breathing, complex system of different players. And the most important takeaway is this. Every single trade is a debate. When you buy, someone else is selling because they disagree with you. Maybe they have a different timeline, a scalper selling to your long-term investor. Or maybe they have a different strategy, a reversal trader selling to your trend follower. Understanding their potential motive is the first huge step to understanding the market itself. And that leads us to our final and maybe the most important question of all. Now that you've met this diverse cast of characters that make up the market, it's time to think about your own role in all this. Understanding the game is the first step. The next one is choosing how you want to play it.